To every man with a hammer, every problem looks like a nail. Hi everyone, welcome back to my channel, and if you're new here, my name is Tess and I make videos talking about books, my investing journey, as well as documenting my life as a final year uni student here in Singapore. So in this video, I'd like to share some of the mental models or frameworks that I think are very useful for investors. So before we begin, what are mental models? Mental models are basic ideas in each discipline that helps us to understand the world better. So for example, in the world of mathematics, there are concepts that we learn such as probability, normal distribution curve, law of large numbers that actually help us to understand the world better. And in the world of biology, there are theories such as natural selection and evolution theory that helps us to understand life on Earth. So it's important for us when we make decisions, especially as investors, to have these mental models in our toolkit. So to put it in one sentence, mental models are basic units that help us to construct our worldview. And you can think of mental models as tools in your mental toolbox, aka your brain. So when you're faced with a problem, you can just pick out the relevant tools or the mental models that will help you to solve the problem in the most rational way. So building up your range of mental models in your head is very important because, as Charlie Munger once said, to every man with a hammer, every problem looks like a nail. So which means that, if you only have one hammer, which, represent a counting tool, only able to use that mental model to solve your problems. Here are my top 8 mental models and frameworks for investors. First is to know the difference between price and value. So a price of a stock doesn't equate to the value of the stock. And as Warren Buffett said, price is what you pay, but value is what you get. So when we look at the stock price of a company, it doesn't mean that the higher the stock price, the more valuable this company is, and the lower the stock price, that means the company is not valuable. So if you look at how Warren Buffett actually invested in his early days, he actually used this method called the cigar butt investing style, whereby he's on the hunt for cigar butts. So what is a cigar butt investing style? So essentially, a cigar butt investing style is about purchasing companies that are undervalued and are trading at a low multiple. However, these companies have poor fundamentals and they are like what Warren Buffett coins as cigar butts, with only 1 or 2 puffs left before it is being discarded. These companies are undergoing financial instability and have limited growth, which is the reason why they are priced so cheaply in the market. So when we know the difference between price and value, it can help us to stay away from companies that are going on a secular decline and those that are experiencing disruption in their business models. As Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The second mental model is second order thinking. Having second order thinking helps us to see things that others can't see. And this is very important, especially when investing. So when you're using second order thinking, it means that you're viewing the problem not just as a silo, but rather you're thinking from a holistic view as to what other factors can potentially influence this problem at hand. So I actually made a video about first order and second order thinking, a term coined by Howard Marks, and you can watch the video over here. First level thinking says, it's a good company, so let's buy the stock. Second level thinking says, it's a good company, but everyone thinks that it's a great company, and it's not. The stock is overrated and overpriced. Let's sell. First level thinking says, the outlook calls for low growth and rising inflation. Let's dump our stocks. Second level thinking says, the outlook stinks, but everyone is selling in a panic. It's time to buy. Second order thinking is difficult and it requires practice. As Charlie Munger says, it is not supposed to be easy, and anyone who finds it easy is stupid. With that being said, second order thinking is a superpower that we all have within us. We just have to be intentional about it, and whenever we come across news or company reports, we have to ask ourselves, and so what? Also, think long term. What will be the consequences like in 6 months, 12 months, or even 5 years? To have extraordinary performance, we have to see things that the crowd doesn't see. Next is to build up your circle of competence. So your circle of competence is your level of knowledge and expertise in certain areas. This means that you are familiar with the products and services of the business, which gives you a competitive edge over other people because you can process company information in a better way. So for example, if you are invested in Starbucks, it means that you understand how the company makes money, who are the company's customers, competitors, as well as the future prospects of the industry and the company. And likewise, if you are invested into a manufacturing stock, it would imply that you have some sort of superior knowledge or expertise in this manufacturing sector. With so many technologies and companies that are in the stock market, it's important for us to stay within our circle of competence and only purchase a stock if we truly understand it. Doing your own due diligence, researching and really understanding the company, you can maintain your conviction and confidence in the business and not just panic sell when the stock prices are fluctuating. More importantly, we have to know the parameters of our circle and distinguish between what we know and what we do not know. By drawing a clear line between what we know and we don't know, it helps to protect us against the risk from not knowing what we are doing. Next is to always ensure that you have a margin of safety. So what is margin of safety? Margin of safety means that you're buying a stock at a significant discount to its intrinsic value. In other words, it's the gap between the market price as well as the intrinsic value of the stock. So you can think of margin of safety as somewhat like a buffer that prevents you from making extreme losses in the market. Because when we're thinking about the value of the company, we are always making underlying assumptions that might not hold true, especially in this volatile and unpredictable world that we're living in. It's all about the price that you pay, and margin of safety is designed to help you make money by not losing money. So to recap, these are the 4 mental models that we have talked about. Firstly, know the difference between price and value. Practice second-order thinking and constantly ask yourself, and so what? Understand your circle of competence and only purchase stocks that are within your circle. More importantly, understand the parameters of the circle to avoid losing money from the unknown unknowns. Ensure that you have a margin of safety in your investments and buy a stock at a discount to its intrinsic value. So that's a wrap for the first episode of mental models that I find useful for investors, and I'll see you in the next video. Bye!